Well, hello and welcome to Women of Color, Money and Legacy, where I talk money matters. I share strategies to empower us to become financially literate in terms of managing our money wisely, making important financial decisions, building generational wealth, and creating a lasting legacy. It is a journey of learning and growing together. And I want to start by welcoming all the new subscribers. I'm so delighted to have you join the family. I hope that you are getting value out of the content that I've been sharing. Now do me a favor and click the like button. It helps to grow the channel. And if you enjoy the video, please subscribe to the channel. Now let's get started. Now I'm recording this message the Wednesday morning before the Federal Reserve Chairman Jerome Powell is scheduled to announce his September interest rate increase. Now, investors are nervous about the effect that it's going to have on the stock market. Prospective home buyers are antsy about the effect it will have on their ability to purchase an affordable home. While you might not fall into either of these two categories, this announcement will have a profound effect on all of us as consumers. Now, today I want to make you aware of some key economic indicators that greatly influence our spending and buying power. And this is particularly important to understand because we are currently in a soft recession and many economists project a hard recession is on the horizon somewhere around December of this year or early 2023. And we need to understand some economics. So today I'm going to give you a breakdown of 3 economic indicators, its meanings and ramifications. They are: number 1, the Consumer Price Index, which measures inflation; the Federal Reserve Interest Rate Indicator; and the National Bureau of Economic Research, which measures the recession. And the first key economic indicator we'll discuss is the Consumer Price Index. Now, the CPI is an index that tracks the rate of change of inflation over time. Inflation simply means a rise in prices on consumer goods and services. Last week, the U.S. Bureau of Labor Statistics published an inflation rate of 8.3% for the 12-month period ending in August 2022, which is very high. And that's only slightly lower than the 8.5% rate for the 12-month period ending in July of 2022. Now, you might remember we reached a 40-year high inflation rate of 9.1 for the 12-month period ending in June 2022. And these numbers are staggering because the ideal target rate for inflation is 2%. So as you can see, we are far from that. The price indexes that have been on a surge over the past year are housing, food, medical care, and overall household operations and furnishings. You have new cars, car insurance, education, and energy. Now, we've seen gas prices go down over the past couple of months, but electricity and natural gas prices increased, but wages have not increased across the board. And I don't have to convince you because you feel the pinch just as much as I do. You feel it when you go to the grocery store. Now, I was in the grocery store not too long ago and reached for my usual 6-pack carton of large eggs that were typically like $1.29. They were $2.49. I thought it was a pricing mistake at first glance. Then I received my car insurance renewal and it was up 10%. And go to a nice restaurant for lunch and see how much it costs you. It hits you in the face, I'm telling you. The housing market appears to be headed for a slowdown, but right now homes and rent are still overpriced. Unless you have to buy a house right now, you should definitely consider sitting on the sideline for a while until the housing prices are slashed, and that will be coming soon. So what caused the inflation rate to spike to a 40-year high? Well, a number of different factors, including the COVID-19 pandemic-related stimulus. You remember the stimulus packages. And then we had historically low interest rates that we've enjoyed for more than a decade, like 2.5% on a mortgage. And this year, the Roman invasion of Ukraine caused oil prices to soar. And then we had price gouging on chips and energy supply shortages. And at the end of the day, the high inflation rates are caused by a supply shortage and an extraordinary demand. And that's the problem, an imbalance of supply and demand. Now the question becomes, will inflation ever get back to that 2% target rate? And that's where the second key indicator comes into play, the Federal Reserve. Now the Fed comes in and raises interest rates to bring inflation down. The FOMC holds 8 scheduled meetings per year to review the economic and financial conditions to determine appropriate monetary policy and assess the risks of its long-term goals of price stability and sustainable growth. The committee meets 2 days, and on the second day, Chairman Jerome Powell presents their findings and their plan of attack. Now, the Fed has been pretty aggressive this year with interest rate hikes. Prior to today, there have been 4 rate increases this year. The first rate hike in over 3 years happened in March with a 25-point increase. In May of this year, there was an additional 50-point increase, followed by a historic 75-point bump in June and another 75-point increase in July. And as I stated earlier, we are expecting the Fed to announce today an additional 75-point increase. The Fed is facing a difficult balancing act, needing to aggressively raise interest rates to bring inflation down without triggering a full-blown recession. And to that I say good luck. Although the Fed won't admit it, we're already in a soft recession, and like so many other economists, I believe it's going to get worse before it gets better. I hope I'm wrong, and we'll have to wait and see if the economy cools down with these aggressive rate hikes. Now, one thing that has changed with inflation is people's buying habits. Discount stores like Walmart are attracting more upper income shoppers now. And I've worked in the financial field for most of my adult life, so economy shopping has always been my way of life. So for me, Colgate toothpaste is Colgate toothpaste. Whether I'm buying it, the exact product, for $3.50 at Walmart or $6.50 at the pharmacy, but to each his own. So you have these retail stores like Target and Walmart, they're tweaking their merchandise mix to better accommodate a change in demand. A lot of consumers are choosing private label products rather than name brands. And how many of you are changing your spending habits? Rather than going to the deli meats department and getting Boar's Head, you're getting that private label. Now, I feel you, I'm doing the same thing. Another area that looks to be brutally impacted by these aggressive rate increases in the next few months is housing sales, of course. And the housing market is starting to cool a bit, which is still very costly if you're looking to buy a house right now. The median home price is down to about $404,000, but that's still 11% higher than a year ago. And for the average household, that's still unaffordable. And I don't believe that we're going to see houses dramatically decrease in price like we saw in 2008 when the housing market bubble burst. And that was actually not a real estate bubble. It was more of a financing bubble. And I think we will see home prices go down, but I don't think they will go down dramatically because homes appreciate in value. That's one of the reasons that we buy a house. It's an investment that creates equity. So although I don't believe the housing market will experience a dramatic price spike again like we saw over the past year, I do believe houses will continue to increase, but at a slower pace. So I wouldn't expect the median price of a home to drop from $404,000 to $250,000. I think it will be more like $350,000. That's more realistic, and then slowly tick up from there. Now, I do have a news flash as I'm recording this. I just learned that the Fed has announced a 75-point increase in the interest rate today. And this marks a 3% rate increase so far this year, and the FOMC anticipate ongoing rate increases up to 4.6% in 2003 before ending these rate hikes. A couple of months ago, Jerome Powell warned all of us that the rate hikes will continue even if it results in some pain to our households, including an increase in the national unemployment rate, as long as it takes to get the inflation down. They did say today that the Fed expects to reach their 2% inflation target in 2025, so that's pretty aggressive. Now, the stock market did not take kindly to the news today. It immediately started to plummet. The Dow, the NASDAQ, and the S&P all started to do a downturn. They trended down. The market still has 2 more hours before it closes. So we'll have to wait and see what it looks like at the end of the day. And if you're an investor like me, this downturn slide creates a good buying opportunity. And I do plan to dollar cost average into some of the stocks that I currently hold. Will the market rally tomorrow? We'll just have to wait and see. Now let's move on to our third key economic indicator, and that is recession. The scorekeeper when it comes to a recession is the National Bureau of Economic Research. And this is the organization that declares whether or not we're in a recession. Historically, a recession has been defined as a prolonged downturn in economic activity for 2 consecutive quarters of decline in gross domestic product. That is until the end of the second quarter of 2022, when they changed the definition of a recession after seeing this 2 consecutive quarter decline in GDP. They are now saying that employment must also be factored into the equation, noting that jobs are being added and unemployment is down. Now, make no mistake about it, we are in a soft recession. The question is, how deep will the recession go? Will the rate hikes actually trigger a hard recession? Now, economists are divided on this issue. Some are saying they see no signs of a recession, while others are saying that there is a recession in the future. Now, the FOMC has pretty much made it plain that it will accept a hard recession in the name of fighting inflation by inflicting pain on us as long as it takes to get that inflation down to the 2% target rate. So all I can say is buckle up, because we might be in for a wild ride. And that being said, should you be concerned about losing your jobs should the economy slide into a deep recession? At this very moment, according to a former Federal Reserve economist, we have twice as many job openings than we have workers searching for a job. So it's hard to see how we can be in a recession with that kind of job growth. But on the other hand, big companies are already announcing layoffs, including Best Buy, Ford Motor, HBO Max, Peloton, Shopify, Walmart, Wayfair, and Federal Express. And a survey shows that 50% of firms expect job cuts in the next 6 to 12 months. So if I'm an employee, I would definitely be in the frame of mind of creating a recession game plan. And for months now, I have emphasized over and over again setting up a 6-month emergency fund. Given the current economy, I would advise increasing that fund to up to 1 year. And if that seems out of reach, then start with 1 month. Then try to push it up to 2 months, 3 months, and so forth. Another thing I've emphasized is living below your mean. That is particularly important right now. Only spend money on what you need. Take that excess money that you have and add it to that emergency fund. And I'm going to continue to emphasize getting out of debt. You want to work on paying off those revolving credit cards, because if you get laid off and you can only make the minimum payment each month, your balance is going to continue to grow because interest is still accruing. So you definitely want to work on paying off those credit cards, with special attention being paid to the ones with the higher interest rates, okay? Part of being financially literate is to understand these key economic indicators, because they have a profound impact on your pocketbook, your wallet. So you want to pay attention when you hear discussions about consumer price index, Federal Reserve meetings, and other recession triggers, okay? Now that's going to wrap up all that I want to share with you today. I hope this information has been of value to you, and I'll return next week with another video on mastering your money. Now don't forget to like, share, comment, and subscribe to the channel. Click on that notification bell to receive an alert each time I upload a new video. Take care, and I'll talk to you soon.